So let's continue with our discussion where we left last lesson. And we said that within the first 2 weeks or 1.5 week, we should have concluded chapter 1 of advanced financial reporting. I remind you that in chapter 1, you have seven subtopics to cover. That is, chapter 1 is covers accounting for assets and liabilities. You need to cover leases, which we have been doing for the last 2 lessons, and we want to conclude that chapter for leasing today. So leases is one of the chapters, subtopics, the topics in chapter 1. So leases, then deferred tax with group aspects. So after leases, we move to deferred tax. Another topic is employee benefits, then share-based payments, financial assets and financial liabilities, including impairment, pension, eventual derivatives and disclosures, fair value measurement, and impairment of assets. Those are the topics that we are supposed to cover in chapter 1. So we can conclude where we left about leases, and then next lesson we'll move to deferred tax with group aspects. Now, there are certain very important things that I want us to mention here before we conclude leasing. Last lesson I told you that today I will mention a major thing concerning International Financial Reporting Standard number 16 and IAS 17. So note that International Financial Reporting Standards IFRS 6 superseded IAS 17 in the year 2019, and IFRS 16 came into effect 1st January 2019. As I promised you that I was to tell you the major difference between IAS 17 and IFRS 16. Simply, the difference here is that as far as IFRS 16 is concerned, it requires that the lessee should recognize the asset as well as recognize the finance lease obligation. As we said last time, that a lease, that is a finance lease, creates an asset as well as a liability. So whenever a lessee leases an asset, the assumption here under the IFRS 16, that is International Financial Reporting Standard number 16, the lessee should recognize that particular asset in his books of accounts, and again on the other side, he or she should recognize a lease obligation or a liability in that case. Now, the other difference is that IFRS 16, as I think you have noted that difference, because if you look at IAS 17, the provision was slightly different in the sense that it requires both parties to classify lease as either finance lease or operating lease. So in the IFRS 16, as I have said, it requires one, the lessee to recognize the asset in his books as an asset, recognize that particular asset in his books of accounts, and then recognize a liability. Why is he supposed to recognize the leased asset in his books of accounts? The reason is simple, because he has a right over that particular asset. So definitely, if he is recognizing that asset in his books of accounts, then he is supposed to provide for depreciation for that particular asset. Then why is it necessary and appropriate for the lessee to recognize a finance lease obligation or as a liability in the books of accounts? The answer is simple, because he or she has an obligation to pay rental payments for that particular asset. We defined a liability as that which has where there is any transaction which brings about the possibility of cash outflow in the future. So in this case, because you are leasing an asset and then you have a responsibility to be paying for the rental, making the rental payments, then obviously that becomes a liability. Because once you lease an asset, you have to pay these annuities for the entire lease term. That's important. Now, the same IFRS 16 requires that the leaser should classify the lease as either finance lease as well as operating lease. So you can see the difference there. So in summary, to summarize the difference between IAS 17 and IFRS 17 is that IFRS 16 requires the lessee to recognize the asset as well as a liability in his books of accounts. And the leaser, that is the owner of the asset, to classify the lease as either operating lease or financing lease. So in this case, IFRS 16 does not require the lessee to classify the lease as either operating or financing. So it is as if IFRS 16 requires the lessee to always recognize this type of lease as always finance lease. That's what it means simply, in simple terms. That is, IFRS 16 requires the lessee to always classify any lease as finance lease. Now, the next important thing for us to note is that because we are saying the lessee must recognize the asset in his books of accounts, then obviously he must be depreciating this particular asset. We know how to calculate depreciation for sure. Is cost of the asset we minus scrap value divided by expected useful life. Important note to note here. If the expected life of the asset or the useful economic life of the asset is different from the lease term, then which number of years are we supposed to use? We are going to divide by how many number of years to get depreciation, assuming that we are using straight line method. So take an example whereby an asset has economic useful life of 20 years, or let me use 25 years. An asset has economic useful life of 25 years, but the lease term is 15 years. 20 years, 15 years. 20 years, 15 years. This asset can last for 20 years, but I lease it for 15 years. So for me to calculate depreciation, we are supposed to take the lower. You compare the expected life of the asset and the lease term, so you're going to use the lesser. So in this case, I use 15 years. So I'll take cost of the asset divided by 15. You don't divide by 25 or 20 or 30. You compare expected life of the asset and the lease term. You are leasing this asset for how many years? So you divide by the lower, just like, because you are just comparing 2 years, expected life and the lease term in terms of the number of years. So you divide by the lesser. That's important point that we are supposed to know there. As far as depreciation is concerned, another thing that we should note is about the lease obligation or that liability, which we have said IFRS 16 requires the lessee to recognize. Now, how do we calculate that lease obligation? We did that last lesson, and we said you take the annuity, that is a constant figure which is being paid, you multiply by present value annuity factor. Now, we showed you how to go about it, but what I want to mention here is situations where the cash flows are being made by the end of the year, what we call ordinary annuity. Other situations, these cash flows may be made by the start of the year. So there has to be a difference there. That if you are making these payments, because whenever you lease an asset, you're supposed to be making a certain constant figure by the end of the year or even by the start of the year. That's a major thing. If you are making these payments by the end of the year, then that changes the approach that we are going to use to calculate that liability or that obligation that you have. If the cash flows are occurring by the end of the year, you say that is called ordinary annuity. So you just take here, as I have written here, this is a formula here. If cash flows are taking place by the end of the year, here note minus n, negative n. Now this part, if you have done financial management, you can read it from the table. But if the table has not been provided, then this is how you calculate it. Annuity, the constant figure that you are paying. Because you lease an asset and then you are told you'll be paying 50,000, 50,000, 50,000 each year for maybe next 5 years. So in that case, the 50,000 that you are paying is an annuity, which you are supposed to multiply by 1 minus 1 plus r. R is the implicit interest rate, then raised by negative n, the number of years. For example, if this lease is for 10 years, then 10 years becomes your n. So you raise that number here, you raise this formula here by negative 10. Then you divide by r. R is an interest rate implicit. Maybe if it was 15%, you divide by 0.15. Now that is a situation where the cash flows are occurring by the end of the year. That is, you are paying these, you are making these rental payments by the end of the year. However, you note that if you are told that the lessee is making these payments by the start of the year, then this one will not be 10, this will be 9, it will be less, it will be less by 1. Why is it less by 1? Because you realize that if you are making payments by the end of the year, already the first year counts. The first year counts. But if you are making these payments by the start of the year, what does it mean? Obviously, there is a difference of 1 year. If you are making payments by December and another person is making payments by January, there is a difference there of 1 year, depending on when are you making your payments. So note that where payments are being made by the end of the year, then obviously you raise your formula here just by the total lease term, negative total lease term. But if these payments are being made by the start of the year, like January, then your N will be less by 1 year, the difference. That is important point that we should note there as far as that explanation is concerned. Now, this step 1 here helps us to understand how to calculate the lease liability, and you are supposed to calculate the present value of these future cash flows that you'll be making. So that is the first step. Now, the other part is to do with right of use of the asset. Since we have said International Financial Reporting Standard number 16 requires the lessee to recognize one, right of use as well as the liability or the obligation. So we should be able first to ask yourself, are you able to calculate the obligation? So I have told you that to calculate the obligation, it entails calculating the present value of those particular expected annual cash flows that you'll be paying the owner of the asset. Calculate the present value. If, for example, you are paying 50,000 per year, and this lease is for 5 years, it means calculate the present value of the 50,000 as at today. The same concept that you have done in financial management. So if you have a problem with calculating the obligation, you can just revisit your financial management of advanced FM, which again you are doing at this level. So I don't expect any one of you to have a challenge with respect to calculating the obligation that the lessee is supposed to recognize in the books of accounts. So it's just calculating the present value of that particular annual payments. Now, once you have done that, the next step is to calculate the right of use of the asset. How is he supposed to recognize that asset in the books of accounts? So the first thing, the arrangement is here. So you'll be picking the lease liability, which you have calculated above here. That's one. 10, we are saying we are calculating right of use of the asset. What is the value of the asset that the lessee is supposed to account for in the books of accounts? So take the lease liability, the figure that you have calculated above here, then we add any lease payments before commencement period. So if you leased an asset and you have paid some additional amounts for whatever reason, then you should add that particular amount which you have incurred with respect to this lease to the lease liability, this figure you have here. So start with the lease liability, and I've said this lease liability is the same as the one we have calculated here. We earn any lease payments. Is the leaser telling you to pay any additional amount for whatever reason? You earn that figure there. Another thing that you earn is the initial direct costs like legal costs or consultation costs. If you incur any costs in the process of negotiating for this lease, then you should earn it there. Then you also earn dismantling or removal cost. If there is any cost which you have incurred with respect to dismantling the particular machine or the particular asset, then you should add it there. Because sometimes you may lease an asset and then before you return this asset to the owner, when the lease term expires, then it may require some dismantling so that you may return the asset to the owner. So that cost, if it was there, then you should add it there. Then lastly, you minus, you can see there is a brackets, we are lessing any incentives by the leaser. Did you get an incentive from the leaser? So you less that. Because an incentive is not a cost. It's a minus, you minus it here, and then the answer that you get is right of use. So these two now, as I think we are able to understand that how to calculate, how to recognize the obligation, that is the liability, which the lessee is supposed to recognize in the books of accounts, which is the present value of those particular annual payments, having in mind that they can be made in arrears, that is by the end of the year, or by the start of the year. If they are being made by the end of the year, you just raise your formula by the total lease term. If these payments are being made by the start of the year, then you raise your N by less 1. You just look at what is the total lease term, then you minus 1. You minus 1. So you less this number by less 1 if the payments are being made by the start of the year or they are being made in advance. And then right of use of an asset, you remember to start with the lease liability, which you have calculated there, and I've shown you what you should earn here, and then you arrive at that. Now, the next thing that I have mentioned is you should depreciate this particular asset, because you have said you should recognize this asset in your books of accounts. So if you have recognized this asset in your books of accounts, then definitely you should be the one who is depreciating it. So depreciate this asset, and we know how to depreciate assets. Cost minus uh, scrap value, if there was a scrap value, divided by expected useful life. The most important thing here to note is you may have this asset leased with lease term different from the economic life of the asset. So I will divide by what? By which number of years? If the asset, for example, has economic useful life of 20 years, but I have leased it for 10 years, will I divide my cost by 20 or by 10? So I have told you, you take the lower. So you divide by 10 in this case. So where there are 2 years involved, in other words, where the useful economic life is different from the lease term, then you take the lower, you divide by the lower. So that is depreciation, how you depreciate that particular asset. Now, away from that, the other thing that I want to show you here is how to prepare the lease amortization schedule. The lease amortization schedule. The information that we present in the lease amortization schedule, we will use it to establish whether we have the amount of current liabilities and non-current liabilities by the end of the year. Now, very important thing for us to note here again is we should also remember to identify whether the payments are being made by the start of the year or by the end of the year. Because if we are making the payments by the start of the year, it means that when we are calculating the present value, the first payment, which was made by January, is already in its present term. So we cannot calculate its present value. And again, when we are calculating our interest, then the total amount upon which we are computing our interest on is less, because part of the lease has been paid. So that's the important thing, identifying whether the cash flows are occurring by the start of the year or by the end of the year. So the situation, as far as our lease amortization schedule is concerned, will be affected by the fact that the payments are being made by the start of the year or by the end of the year. I'll show you the reason for that. Now let me show you what I'm trying to say. How the time upon which payments are being made will affect our lease amortization schedule. Now, let me assume that we are preparing our lease amortization schedule here, and I assume that payments are made in advance. Because in the previous question that we did, I think December 2022, question 1B, the last lesson, we did a question there where cash flows were occurring in arrears. So the cash flows, the payments being made in arrears, you do not have a problem with this part, because we did a question last lesson whereby there was a lease and the cash flows were occurring by the end of the year. The cash flows were in arrears. Now let me show you what I mean. Now what I mean is that your amortization schedule, the lease amortization schedule, you know that you usually have 6 columns. The one for years, balance brought forward, the installment, subtotal, interest, the balance carried out. Now look at that. If cash flows are occurring in advance, I will have a column for the number of years, year 1, year 2, year 3. depending on the number of years. The balance brought forward here, this one, I assume that I have calculated my present, the lease liability. So usually, the balance carried down, the opening balance here. The examiner will not give you that. You are the one to calculate. So this figure, the first number appearing in the first year, this number here, the balance, the opening balance brought forward, you are the one to calculate. And where does it originate from? It is the present value of the lease payments, that obligation. You know, we are saying that the lessee should first recognize the liability by the start of this leasing agreement, because I have an obligation to be paying the leaser, the owner of the asset. So once I establish that obligation, that number, I'll bring it here. Note I'm trying to explain situations where the payments or the installments are being made in advance, that is by January. So we have calculated the balance brought forward as 2,000, that is from here, assuming this part here, you took the annual payments, you multiply by this, and here you raise by negative that particular number, which is less by 1, obviously, and you got 2,000. Now, the next column is installment, the fixed figures which you are paying. I assume that you are paying 200 because in leasing, you have said you should be paying a particular fixed amount each and every year. Now, here we are saying we are paying these installments, the annuity, in other words. This portion here is the annuity, is still the annuity here. If that annuity is occurring by the start of the year, what does it mean? It means that we cannot calculate interest based on the opening figure. I think you realized the previous example that we did. We were picking the balance brought forward, then you multiply by the interest. Why? Because by the start of the year, the 2,000, we paid the installment by the end of the year. By the end of the year, not by the start. Now, in this situation here, we have paid our installment, the 200, which is the annuity figure, by the start of the year. So our interest cannot be based on 2,000. So we have a column for installment. So first we should less the 200 which you have paid, because payments are being made by the start of the year. The payments are being made in advance. So you take your opening balance, the 2,000, the present value of the lease obligation that you have, minus that installment which is being made by January. You less it. Then the answer which you get is the subtotal. That is what remains. We started with 2,000, we paid 200, so our obligation is 1,800 by the start of that particular year. And then this one now, you calculate interest now. If the interest rate implicit is 10%, then what remains here, you multiply by 10% to get this interest in that particular year. So the balance carried down now, you just take 1,800, the subtotal, you plus this particular interest, and then this is the balance carried down. The balance carried down becomes your opening balance here. So the 1980 is your opening balance here. Note that the payments that we are making for this lease is being made in advance. We are making the payments to the owner of the asset by January. So we cannot calculate interest on 1980. We should open the accounts with 1980, then immediately we less the annuity that we have paid the owner. So we less, you have 1980, we less 200 now to get the subtotal. Then this subtotal is what we have now by the start of the year. So we calculate interest on this, which is 10% of this, we get that, and then this plus that. The subtotal, you add the interest, and this is a closing balance. That becomes our opening balance here. So this opening balance again, January, we pay, we make the installment, and then we get the subtotal, that is what remains. The balance, the opening balance, you minus the installment, you have the subtotal, calculate interest on this, you get this, and then you have the closing balance. So the process continues. Now, important thing to note here is that in this amortization schedule, we should be able to identify what is the current asset here and what is the non-current asset. A current asset, not asset but liability, I beg your pardon, not asset, liability. That is because it is in the books of the VC. Okay, what is a liability here is an asset to the other person. But let's see the meaning of this. If I want to know what is my non-current liability here, so liabilities you always take them from the closing balances, the balance carried down by the end of the year. That's where you get your liability. Now you realize that by the end of the year one, the balance here is 1980. But if you go to year two, the next year there, you realize that this liability has reduced. So current liability is that liability which is paid within 1 year. A non-current liability is that liability which takes more than 1 year to pay. So if I want to know my current liability here, I'll check this 1980 by the first year. Then I go to second year, I realize that this figure reduced from 1980 to 1958. So it has reduced by 22. So between year one and year two, I was only able to pay 22, the difference. So the 22 now is a current liability because it was paid within the first year. Now this balance here, the 1958 means it is part of 1980, but we were not able to pay it within the first 1 year. So that liability which we are not able to pay within 1 year, it becomes non-current liability. So my 1958 here becomes a non-current liability in the first year. You move to year two. What is my current liability and my non-current liability? If you compare 1958 in year 2 and year 3, 19, that 3.8, it means that in the second year, my liability was 1958, but in year 3, it reduced to 1933.8. So it reduced by 242. So I was able to pay 242 shillings in year 2. However, because 1933.8 is part of 1958, we were not able to pay 1933.8 within the course of the second year. So 1933.8 becomes the non-current liability. So simply, the non-current liability and current liability, we established that one that way. But the most important thing for us to note here is that whenever payments are being made by the start of the year, we should first separate that installment which has been made so that we may calculate interest based on what is remaining. Okay, then the next part is this one, where payments are being made in arrears. Now that is in our previous example which we did. You can just check that example that we did for December 2022, question 1B. It was talking about Vox Limited, list an asset from Tiana Limited. You are given interest rate, implicit, and other information. So the question that we did in the last lesson was to do with payments being made in arrears. Therefore, here you have a column for the number of years, opening balance, interest. So you can see here where payments are being made in arrears, that is by the end of the year. You just pick the opening balance, you multiply by the interest rate implicit straight away. If you compare the first example here, we are first subtracting the item which is being paid, the amount, the lease rental which is being paid. First, you must separate, you must minus the lease rentals. Why? Because they are being made in January. So we cannot calculate interest on 2000 because you are making this payment by January. So you should make we should calculate our interest on the difference between this and that. But here, the payments are being made in arrears. That is by the end of the year. So these 2,000 or the opening balance simply, we have it throughout the year. Therefore, we should just calculate interest based on the opening balance. That is why we took 10% times 2,000, we got 200. Then subtotal is 2,000 plus interest, we have 2,200. Then we less, I assume we are making installment of 3,000. This is the annuity, constant figure. I assume we are making this, these payments are constant throughout. So we less that, so opening balance, you multiply by interest rate implicit, which I assume 10% times that. You plus that, you have subtotal of 2,200 minus the installment which you are making per year now, and then you have the closing balance. Your closing balance becomes your opening balance the next year, 1,900. Calculate interest on this, which is 10% of 1,900 is 190. Subtotal, you have it here, and then you less that particular annuity, you have the balance there. The closing balance becomes your opening balance. 10% of that, you get that. So you continue the process. So I believe you have identified the difference that arises when you are preparing lease amortization schedule based on whether the payments are being made either in arrears means by the end of the year, or the payments are being made in advance, that is by the start of the year. Another important thing that I think you have learned in this lesson is out of the closing balances in the lease amortization schedule, how do we identify the non-current asset, the non-current liability, and the current liability. So if you want to identify what is my current liability this year and what is my non-current liability this year, you just go to the closing balances by each year, then check what is the balance carried down next year. The total balance carried down next year is your total non-current asset. The difference between year 1 and year 2, year 1 and year 2 forms the component or the element of the current liability. The difference between, you realize that from year 1 going downwards up to the end of the lease term, those amounts are reducing. When the lease term expires, the column here, this column here of balances carried down, will have a zero balance. There will be no balance. So those figures are reducing all through. So part of the balances in year 1, or if you compare the balances in year 1 and year 2 and year 3, year 3 and 4, year 4 and 5, that way, you realize that the figures are reducing downwards throughout. So that is it about that particular portion. So as you can see from that recording, I think in summary, if I was to summarize that, as you see what is written there, is that in conclusion, because I think you have the computations there, the computations which you need, that is the only computations, these are the only computations which you need. As far as leasing is concerned, the computations, one thing is be able to calculate the lease obligation, right of use of the asset, or the amount of assets to be recognized in your books of accounts, then prepare lease amortization schedule, and then should be able to prepare income statement extract or statement of financial position extract. Statement of financial position extract is these figures, as I have told you. Separate which part of it comprises of current liabilities and current liabilities and non-current liabilities. Then what is income? The interest here is the income to the leaser, and this is an expense to the lessee. the interest. So that is the items that you are supposed to note. So if I was to summarize that, now let me go back at the back side so that you may be able to see what is on the board, because I think I'm blocking you from seeing what is on the board. So you can just look at what is on the board, you're able to see it clearly. And as I summarize it for you from the back side, is that what I have said simply is that IFRS 16 is the International Financial Reporting Standards for Leases, issued by the International Accounting Standards Board, that is IASB. It became effective on 1st January 2019, replacing the previous lease standard IAS 17. IFRS 16 sets out the principles for the recognition, measurement, presentation, and disclosure of leases. The core idea is to ensure that leases provide relevant information that faithfully represents lease transactions and provides a basis for users of financial statements to assess the amount, timing, and uncertainty of cash flows arising from leases. As I have told you again, that IAS 17 was providing that the leases should be classified into two: operating lease, also known as off-balance sheet, and finance lease, known as on-balance sheet. That was according to IAS 17, that leases should be classified as either operating lease, also known as off-balance sheet, and also finance lease, also known as on-balance sheet. However, IFRS 16, now which superseded the IAS 17, has eliminated that particular distinction in the sense that the lessee should recognize a lease liability for the present value of the future lease payments, and then recognize a right of use, that is asset, representing the right to use the asset during the lease term. So I have shown you how to calculate the lease liability for the present value of the future lease payments, and also how to recognize your asset, how to calculate the value for your asset. The step number 2, as it appears from the board, is self-explanatory. Now, initial measurement of the right of use of asset, as I have explained to you in the board. At the commencement date, a lessee shall measure the right of use of the asset at cost. The cost of the right of use asset shall comprise of, you can see from the board, comprising of what? 1, the amount of the initial measurement of the lease liability as described in paragraph 26. Now, paragraph 26, you find it in IFRS 16. Then another item will be any lease payments made at or before the commencement date, less any lease incentives received. Number C, any initial direct cost incurred by the lessee. And number D, an estimate of costs to be incurred by the lessee in dismantling and removing the underlying asset, restoring the site on which it is located, or restoring the underlying asset to the condition required by the terms and conditions of the lease, unless those costs are incurred to produce inventories. The lessee incurs the obligation for those costs either at the commencement date or as a consequence of having used the underlying asset during a particular period. Now, that is initial measurement of the right of use of the asset. That is, how should we calculate the right of use of the asset? That is the amount in terms of shillings or dollars or euros or whatever currency that you will be depreciating. The step number 2, as it appears there in the board, is what I have just explained to you. That is initial measurement of the right of use of the asset. Then initial measurement of the lease liability. For lease liability, I've shown you how to calculate the present value of lease payments. That is, at at the commencement date, a lessee shall measure the lease liability at the present value of the lease payments that are not paid at that date. Not paid, that are not paid. That's important. And that is where we have said you differentiate between payments being made in arrears and payments being made in advance. So it is only present value of the payments that are not paid at that date. The lease payments shall be discounted using the interest rate implicit in the lease, if that rate can be readily determined. If that rate cannot be readily determined, the lessee shall use the lessee's incremental borrowing rate. At the commencement date, the lease payments included in the measurement of the lease liability comprises of the following payments for the right to use the underlying asset during the lease term that are not paid at the commencement date. Fixed payments, including in substance fixed payments as described in paragraph B42. Now, B42 again, you find it in IFRS 16. You less any lease incentives receivable, then variable lease payments that depend on an index or a rate initially measured using the index or rate as at the commencement date. Amounts expected to be payable by the lessee and the residual value guarantees, the exercise price of a purchase option if the lessee is reasonably certain to exercise that option, and all that. So that is something that I think I've told you right now. Then subsequent measurement. So once you have made your recognition, what constitutes the subsequent measurement of the right of use? So that is to do with the depreciation, as I have told you. After the commencement date, a lessee shall measure the right of use asset applying a cost model unless it applies either of the measurement models described in paragraph 34 and 35. So cost model is the most appropriate. To apply a cost model, a lessee shall measure the right of use of the asset at cost, less any accumulated depreciation and any accumulated impairment losses, and adjusted for any remeasurement of the lease liability specified in paragraph 36C. A lease shall apply the depreciation requirements in IAS 16, that is PPE, in depreciating the right of use asset, subject to the requirements in paragraph 32. Now, I believe that is what we have just learned, and that is what we have discussed, as you can see from the board. So, I think you are able to see all what is on the board is an explanation of IFRS 16. Everything is there. And I think I've told you that IFRS 16 requires the lessee to recognize the lease as both an asset as well as a liability. As asset because you have a right to use the asset, and as a liability because you have a future obligation to pay the lease payments. IFRS 16 replaced AIS 17, as I've told you, in the year 2019, 1st January 2019, which required the lessee to classify the lease as either an operating or a finance lease. This is not the case with the IFRS 16. So the lessee should recognize a right of use of the asset and lease liability. So in that case, it means you debit the right of use of the asset. That is, you debit the asset with that particular amount that you have calculated, and then you credit the lease liability. So I've told you how to recognize the lease liability by the lessee. is first you should consider whether the payment is being paid either in arrears or in advance, because this will affect your end. You are raising your number by what? You are raising that formula of yours by what number? Is it by 10 or by 9? Is it by 20 or by 19? So you calculate that present value of lease payments not paid at the start. So when the payments are in arrears, for example, it means your N is 10. But if payments are in advance, your N means to be 9. Remember, it's a negative always, negative, because you are calculating the present value. Because the amount paid is already in its present value. So there is no obligation for year one. That's a very important point when payments are made either in advance or in arrears. So I have shown you there, as you can see from the board, how to calculate right of use of the asset. That is how much it will cost me to lease that particular asset. The subsequent measurements, which is to do with depreciation, I've shown you again there. That is the right of use of the asset should be depreciated, because leasee has recognized this particular asset in his books of accounts. Therefore, he should as well depreciate that particular asset accordingly. And I have told you that if the expected useful life, now let me clarify this. Now somebody's not getting what I'm saying there. Now I'm saying depreciation is equals to cost over expected useful life. Now this is what I mean. Now you don't understand what I'm saying. You have not gotten that point. We are saying that the IFRS 16 requires that the lessee should recognize the obligation as well as the asset. So simply, it should create a liability and an asset. So because he is the one who is recognizing this asset as if it belongs to him or her, again, he should depreciate that particular asset. So we are asking that point, we are saying if the expected life is 10 years and lease term is 5 years, how will the lessee depreciate? Assuming the cost, let me assume the cost is 1,000. How will you depreciate that asset? Because depreciation is given by cost over expected useful life. Now, if there was a scrap value, you less, or if there was residual value, you also less. But I assume that the cost is 1,000, and this asset has total useful life of 10 years. It can only last for 10 years. But I lease it for 5 years. We are saying you take the loan. So I will take, if I am calculating depreciation for this asset, which I have leased, I'll take 1,000 divided by 5, because 5 is the law, which is 200. So my depreciation per year, I'll be using 200 shillings throughout. You not take 1,000 over 10, no. Compare expected useful life of the asset and the lease term. So you take the loan to get your depreciation. So your debt now will be shillings 200. So that is a point which I have clarified there for you. That's very important. So I think that only I have clarified what we mean by that particular depreciation. So the lease liability again should be remeasured at the amortized cost through amortization schedule. So a subsequent measurement means how do we measure the right of use of the asset. So this asset here, which you have calculated the value, subsequent measurement, this asset here, you depreciate it. I've shown you how to depreciate. that particular figure which should be here. Then you amortize this particular figure here, which you calculated here, amortization through the lease amortization schedule. So that is a point which we are trying to clarify there. That is the right of use of the asset should be depreciated. That is under subsequent measurement. Because the examiner can ask you recognition and subsequent measurements with respect to IFRS 16. Now this one here. So you can rectify this point here. So the right of use of the asset should be depreciated, and lease liability should be remeasured at the amortized cost through amortization schedule. So when depreciating an asset with a useful life different from the lease term, you take the lower. So I've told you, for example, if the lease term is 15 years and the economic useful life is 25 years, then you use 15 because you are taking the lower. So we say that the lessee should always treat all the leases as what? A finance lease. The lessee should always treat all the leases as what? Finance lease. Because we say that IAA 17 provided that the lessee and the leaser should classify the leases as either operating lease or finance lease. That was IA 17. But IFRS 16 requires the lessee not to classify the leases as either operating or finance. Don't classify your leases only as a lessee. Now this is to do with the lessee. Only do what? Recognize the asset as well as the obligation. That's the provision. This simply means it's like saying that in any leasing arrangement, then the leaser should always treat the lease as finance lease. But with respect to the leaser or the owner of the asset, the IAS 17 remains the same. That is, the leaser, that is the owner of the asset, should always classify the lease as either operating lease or finance lease. Now, important points to note here, which you can find in the examination. Conditions to be met for a lease to exist or to be recognized. What are the two major conditions that must be met before a lease can be recognized or for a lease to exist? Now, for a lease to exist or to be recognized, for any transaction to be recognized as a lease, then a lessee should have two rights. One, have a right to obtain substantially all the economic benefits from the use of the asset. So that is one right that a lessee should have. That is, have a right to obtain substantially all the economic benefits from the use of the asset. And then number two, the other right is have a right to direct on how the asset should be used. So those are the two major conditions that should be met before we classify any arrangement as a lease term. Or in other words, the two rights that the lessee should have. That is a right to obtain substantially all the economic benefits from the use of the asset, and have a right to direct on how the asset should be used. Now, what else remains in that discussion? What else remains in that discussion as far as leasing is concerned? I think you have understand the two rights that the lessee should have. That is a right to enjoy all the economic benefits from that particular asset. That's a right that the lessee should have. So if you lease an asset and then you are using it to generate certain benefits out of it, then you have a right to enjoy all those particular benefits. That's a right. And then number two is right to direct how this asset should be used. So that is it about that. I think there is nothing else that we need from leasing. As I have told you, you understand how to calculate the liability arising out of that, having in mind that IFRS 16 requires the lessee to recognize the asset in the books of accounts as well as a liability. How will I recognize the liability? That was the question. So I'll take the present value of all the future expected payments that I'll be making. So that's a concept that you have done in financial management and advanced financial management. If I am paying 50,000 each year, then I should calculate the present value of those future payments as at today. So the concept of payments being made in arrears or being made in advance also applies. So if you are making the payments in arrears, that is by the end of the year, and the lease term is maybe 10 years, so you raise this number, this will be raised by negative 10. If you are told the payments are being made uh, in advance, that is by the start of the lease term, you just less one. The end will be less by one. So you just look at expected lease or the lease term, and then you less one, you'll be negative less one, a lesser figure. But not 10 now will be a negative 10. Yeah, they explain that. So have the obligation, and then the other is how to calculate right of use of the asset. What amount will I recognize as my asset? So you start with this liability, which you have calculated then. We have seen what to earn, and the only figure to subtract is any incentives by the leaser. Now, once you have gotten that, the other thing is to amortize the lease figures, or you prepare the lease amortization schedule. Note here, as I have explained to you, when the payments are being made by the start of the year and when they are being made by the end of the year, that is in arrears, your lease amortization tables will be different, because if you are making the payment by the start of the year, our interest will be less. The interest that we are paying should be based on a lesser figure, because we opened with 200 or 2,000. Remember, this is the obligation which you started with calculating here. That obligation here, you have to less the installment. If you are paying for this lease by the start of the year, you less the installment that you are paying, and then the balance which remains, calculate the interest on it. So you calculate the interest on what remains, and then you have you continue that. So first you less what you are paid, whatever remains now, calculate the interest on the subtotal. That is like here, 10% of 1,800, you got that, and then you continue. If payments are being made by the end of the year, that is in arrears, we don't calculate we don't less the payment first, because we are going to, this opening balance, we have it throughout the year. So the interest will be based on the opening balance. So this is this part we did last time, a question which payments were being made in arrears. Then the last part is your balance carried down here. How should I establish my non-current liability and current liability? Which portion should I pay within 1 year, that particular year? And which portion can we see that we were not able to pay within 1 year? And I've shown you how to establish those differences there. Now remember what is, okay, for example, you are told to prepare amortization schedule for 2 years, you're supposed to go after the next year, because you need that the figure for the next year to establish the liabilities. If the examiner tells you prepare amortization schedule for 4 years. So you're supposed to prepare up to 5 years. The next year, the information for next year is always very critical. So that's important. Whenever you are preparing these amortization schedules, always prepare one extra year, which helps you to identify what is my uh, current liability and what is my non-current liability for that particular year. So that is the end of that. We stop at that. We not only stop at that, but we bring the curtains down for leasing. That is the end of leasing. That is International Financial Reporting Standards number 16. And we are able now to do our calculations very well. We know our theories very well. What is our theories, what is in our calculations. I don't expect you to have any difficulties as far as leases are concerned. Now we will move to deferred tax. Remember, we are doing a chapter 1, advanced financial reporting, chapter 1. So we have cleared the leases. So next lesson, we'll move to deferred tax. So if you are still in class, and as I told you last time, if you are studying from other institutions, or you are studying for yourself, or you are doing other professions, and you want to be part of us as we continue with chapter 1. So you can subscribe there in our YouTube, just down there, you click there, you can like the video, you can make a comment, and you subscribe so that whenever we have a lesson, you have it immediately. You compare with what you have done, wherever you are, with what we are saying here, or whatever we are discussing here. So we are through with the leases. We have done leases. Then next lesson, we are going to take deferred tax. We'll be taking deferred taxes. So you get the deferred taxes lessons next time. So we will stop at that for today. So thank you very much for your attention and your patience. You have taken around 1 hour and 10 minutes in that class, but I believe you have understood the concept of the National Financial Reporting Standards number 16 very well. So I can give you an assignment to go and find out. Now write this one as your assignment. Do we have any IPSAs? Do we have any IPSAs? Do we have? Now let me give you that one as a question. Do we have any IPSAs governing leases? Do we have any IPSAs governing leases? And if it is there, compare and contrast it with IFRS 16. So in other words, I can reframe this question this way. Compare and contrast IPSAS. Now IPSAS means International Public Sector Accounting Standards. Compare and contrast IPSAS and IFRS 16 governing leases. So you can try to find out, because the last chapter, which is about public sector accounting standards, is chapter 5. Public sector accounting standards is all about theories. You're supposed to compare. You'll be comparing the IFRS, which we are doing as of now, with the IPSAS, because the International Financial Reporting Standards governs the private sector or the commercial sector. The IPSAS, that is the National Public Sector Accounting Standards, governs the government entities. So before we come to that in the future, as we conclude, try to find in advance IPSAS that governs leases, and you compare it with IFRS 16. If it is there, find out that. So I remind you my number again. If you go to my number should be here. Is plus 254 727 87 10 93. Now that is 3. That is 3. If you are not within the Kenyan boundaries, you start with plus 254. If you are within the Kenyan boundaries, 0727 87 10 93. You may need some books for CIFA, Certified Investments and Financial Analysis. Certified Investments and Financial Analysis. Study texts and revision materials. You can still get help from our side. You can still use that number. We can sell to you some of them. Or maybe you need classes on CIFA. You can still get help from our side. So my name is Mr. William, and this is Fatima Institute. So we meet next time as we take deferred taxes. Advanced financial reporting, we are still ongoing. Advanced management accounting, we are still ongoing. Advanced auditing and assurance, we are still ongoing. So it's upon you just to subscribe there so that you may be getting updates on whatever we are doing. So thank you. We meet again.